All right, so here we go. Welcome everyone to All In on Real Estate. I'm your host, Aaron Goins. I started this meetup because when I was in the military, in my circles talked about real estate. A lot of time we talked about debt and other finance, and enough about real estate. So I want to start a meetup where people can learn about um, real estate and then start building generational wealth for them and their family. So I'm very, very excited to welcome my guest, Mr. Yannik Cudjoe-Virgil. How you doing, sir? You on mute, I think. Yeah,
I'm
you on
doing
mute.
well. I'm doing well. Thank you for having me. I appreciate it.
Yeah, man, I appreciate you coming on here, man. Me and him met on a meetup uh, on my man Brian Briscoe, and we went from there. And I love his story. I really didn't have a lot of athletes on here as meetup as real estate investors, so I'm really excited to have you on here. And let's talk about your story, man, and inspire others. So this is what it's all about. I love just having people on here different backgrounds and just talk about their story because you never know things you might say or a person might say to really get others going. So, man, thank you for coming.
No, I appreciate it. Thank you for having me. And it's always a pleasure to share my story. My background is a little bit different. Got into real estate back in 2017 after retiring from the NFL, and unfortunately, I had a career-ending knee injury as a linebacker in the NFL. And obviously, the statistics say that within 3 years is pretty much what your lifespan is in the NFL. It's one of those sports where it's 100% injury. So, fortunately for me, I picked up the book, kind of like maybe some folks that are listening in, called Rich Dad Poor Dad, and that absolutely changed my life. I can remember spending $20,000 in my first month in the off season, coming off of my rookie year, and it kind of hit me. And just after reading that book and knowing about the statistic, I didn't want to be part of that statistic, right? So yeah, so I picked up real estate, and we've been running ever since.
That's what's up, man. That's what's up. So, I mean, was it anything while you was in NFL that made you think about it? Was it a rookie symposium? Was it something that made you even think about? Did you think about real estate while you was in the NFL at all?
Honestly, I went to school to be a physical therapist, or a trainer of sort, or a strength and conditioning coach. I did kinesiology. I did nothing in finance. And honestly, I didn't have the thought of real estate. Real estate really wasn't in my future, I would say. And so really, I think that book, Rich Dad Poor Dad, picked it up. But truly what happened was, I actually went to a Nashville Predators game, and I met this guy. And at that time, I was with one of my friends, Avery Williamson, who's still active in the NFL. And, he had a nice watch on. And I just asked him, I said, "Hey, what do you do?" He said he does real estate, and specifically commercial real estate. And so he toured me on a couple properties. And, I think at that time he was trying to get me to invest in one of his deals, but he told me the numbers. And I said, "Hey, I think this is something that I want to do." Right. It's one of those businesses where you can really control your destiny. And so I wanted to figure out, what can I do outside of the NFL that would give me the same freedom and lifestyle that I had to some degree, right? And for me, I'm big on freedom, and I found that real estate was the perfect investment vehicle to do so.
What's up? That's what's up. I love it. I love it. I love it. Um, so where did you start? So you read the Rich Dad Poor Dad. What was your first steps when you get into real estate?
So for me, I'm really big on education. And for me, my first kind of stab in real estate was Bigger Pockets. I just immersed myself in Bigger Pockets. I knew that I wanted to get into the commercial space, specifically the multifamily space. And obviously, in that space, it requires you to have deep knowledge in the commercial real estate arena, right? It's not one of those businesses where you can just wake up tomorrow and kind of do a deal, right? I mean, you can, but you may be in serious trouble if you find yourself, acquiring a 50-unit property and you have no idea, what you have to do in due diligence, how to actually operate the property. So for me, the first thing was education. So that was a mixture of getting the education from Bigger Pockets. Another organization called CCIM was very instrumental in me educating myself. And then I also picked up a job with a firm, more so in the private equity space. I started off in brokerage, moved on into real estate private equity. And so that really allowed me to get hands-on experience with a lot of different assets. I've been on teams managing over $1.5 billion in real estate, multidisciplinary portfolio, multifamily, office, retail, the whole nine. So, that really gave me a lot of confidence to go out there and implement some of the same strategies that I've learned from, big time operators, whether it's just for learning from them directly in meetings or doing it within my asset management role. That was my role for the private equity firms that I've worked for. So moved on, full-time syndication, and excited to grow our company's assets.
Awesome. So let me ask you this, and this is something that just really intrigues me. First of all, I want to let you guys know that he went to the greatest university in the world, University of Maryland, College Park. He go Terps.
Go Terps.
And he's from Baltimore, hometown, my hometown as well. Was there anything like the work ethic that you had to go from high school, college into the NFL that you can bring, that you brought over to real estate?
Oh yeah, absolutely. One of the things that I've really brought on was waking up early and structure within our schedule, right? From reading the book, The One Thing by Gary Keller, talks about, focusing on that one thing to actually get you to the next level. And for me, specifically in the NFL space, that was just mastering my craft, right? NFL is, less than 1% makes it. And in order for you to actually get to that level, you have to some degree be crazy about what you're doing, right? It's something that you have to wake up, eat, sleep, and breathe. So, for me, it was taking that same mentality into the real estate space. And, for me to actually get to that level, I had to start, from the educational standpoint, start there and really kind of work my way up and build relationships and work on that. But I think one of the things that helps me within my journey is just waking up early, right? That's something that we had to do, in the NFL space, college, that was pretty much, a staple within my schedule. So yeah, absolutely. It's the same mentality, same structure, the discipline, all of that stuff, when being a full-time entrepreneur.
I love that. I just want to ask that question. I definitely wanted you to explain that because I think that's so important. Is to, crossing over from, and it don't have to be somebody from the NFL, but just what you do as a job, you can cross over to real estate. Just the discipline and things like that you do on a daily basis. Your job, you might not think because you do it every day, but it's certain skills you got to do to succeed, or you get fired. You know what I'm saying? So I definitely wanted to just add that on. I do see. Well, first of all, I wasn't in real estate years ago, but it seems more visible now that you see more athletes doing real estate or doing other entrepreneur stuff. Do any of your former colleagues or current colleagues do real estate? And are they sticking with it, or are they just trying to find something that's maybe quick and make some money off of it?
Yeah. We there's definitely quite a few former NFL players, active NFL players. Our investor base is, NFL athletes and professional, busy professionals, right? So we have some NFL capital within our deals, and that this movement, right, of athlete and is something that's pretty much a staple in pop culture today when we talk about shows like I Am Athlete, just putting guys in the realm of just doing things outside of the the football realm or just athletic arena, right? So we're seeing a lot of people, athletes focus on the entrepreneurial side of things, putting their money to work. There are a lot of guys that are interested in real estate, so I'm just happy to help them whenever they have questions, or just be that person, that point of contact when things come up in the real estate space.
Love it. I love it. You know, I see people like Josh Childress. He has a big fund that he's trying to do. Like it was like $500 million for real estate. You see, you know, more of these athletes doing different things. I think that's great to see. What would be your advice before we start getting deals, things like that? What would be your advice to maybe a young athlete, maybe getting into the NFL or another sport about real estate? Maybe they might be a little bit intrigued by it. What would you tell them?
I would tell them get educated. You know, I know that I've said that a lot of times, but nothing beats education in this space. Just being able to beat someone to the punch, beat another, someone else that's fighting for a deal. The way that you may underwrite the property, may beat their underwriting, which allows you to win the deal. Educating your investors. For me, it starts with education, right? And for me, that's kind of like, in the film room, right? Watching other people make plays, learning from their mistakes, talking to your mentors, so you don't go out there and actually do the same mistakes that, you could have avoided, right? So, if there's one thing that I would say, absolutely just the educational piece that's so crucial when trying to get ahead in the real estate game. And, that's something that I would say to them.
Cool. Any bumps in the road? Anything that you learned that you had to learn the hard way with so far in your current real estate career?
I would say, our focus today is the multifamily space, the syndication space. We primarily focus on B and C class multifamily in Baltimore, and we're, expanding into the Mid-Atlantic market. But I would say, to actually do deals, bigger deals, you really have to focus on a team. And I think one of the things that hindered my progression in my real estate business was trying to think that I can do it by myself. And maybe you can do that in the single family space, but really when you get to larger multifamily and you're trying to pool, millions of dollars of capital, syndicate these deals, it's a lot of work. Closing the deal is one thing, but actually operating the deal and renovating, 50 units is another set of work that people don't really talk about, the operational side of things. So in order to actually excel at a high level, you really have to have a team around you and know how to delegate and know how to, put people in the right positions so they can shine. And, that's something that I've learned, being a captain within the professional space. And, that's something that I should have implemented, quicker than I am today. But absolutely just, leveraging your team to do deals, to, drive your business forward is something that I wish I would have done earlier on in my real estate career.
Cool. So what been your experience so far? Like as far as deals or anything like that?
Yep. So we primarily do multifamily deals in Baltimore, Maryland. We own, single family duplexes and stuff. Within the syndication space, we own 40 units, and we're looking to expand into larger assets and doing bigger deals. And obviously the market right now, the capital markets is insane, right? We're touring deals all the time. We are finding that deals don't pencil, prices are insane. It's really hard to get investor returns when you have lower leverage and higher interest rates. And, we're starting to see sellers kind of adjust a little bit from pricing perspective. But I think that, the outlook on the economy, forecasting is, where is inflation going to be? How are these, midterm elections going to play out? Really taking a look at, the economy right now and, the nuts and bolts behind it. And I think, the Fed is ultimately, I think, is going to dictate a lot of that, right? If we get, if we continue to get, higher inflation, then we can expect that rates are going to keep going up, right? So, it's an interesting time. And, for us, it's about financially engineering our underwriting to make sure that we play defense on these acquisitions. But we can't be too conservative, right? Because we're not going to win any deals. There's a lot of capital out there that's looking for multifamily. Excuse me. So yeah, that's just a constant battle every day between the markets and the liquidity in the market.
Right. Absolutely. Absolutely. So, what they said the hardest deal is the first deal. How hard was that first deal for you? What was your experience with that first deal?
It was I would agree with that. I would agree with that. Our first deal, our first syndication deal that we've done on the GP side, was an 18 unit deal. And it was one of those deals where it kind of just, was a perfect deal, so to speak. It was in our backyard. We knew a lot about the area. It penciled well. But before that, it was very hard to to actually, get the first deal done. And that was pretty much because of the team aspect that I mentioned that I wasn't focusing on, right? A lot of people want to get into the syndication space, but again, it's all about your team. So finding that crucial partner that you can tag team with to go out and do deals is something that's extremely important for you to find early on. Because there's so many, there's so much to do within the actual day-to-day syndication activity, and then also there's the capital on top of that, right? And then you also have to go find a deal. So I'm excited to show you guys today kind of my blueprint to doing your first deal. And my goal after this is to inspire you to go out there and put your team together, raise the capital, get the financing, and close your first multifamily deal.
Floor is yours, sir.
All right. So let's see if I can take calm here. Let's see here. Sorry, give me 1 sec. I just need to allow Zoom share. Here. Sorry about that. I have this security thing up. I just need to allow Zoom.
And what year was you what years you play at Merlynn? What years you play at Merlynn?
I played 2012 to 2014.
The fridge area.
Well, that was actually the Randy Edsel.
Yeah. I forgot about the Randy SR. Yeah, because y'all had the crazy uniforms.
Yeah,
Yeah. First crossover to Under Armour.
Yep. Yeah, we Faridge actually just he just got an award. Well, not necessarily an award, but inducted into the Hall of Fame.
Okay. We're talking about Ralph Friedgen. He was a long time University of Maryland college football coach.
All right. So can you guys see my screen here?
Yes, sir.
Okay. All right. So again, I appreciate you guys, taking the time to come out here and obviously, it seems like some folks may be interested in some multifamily, right? It's one of those spaces that, it's a great investment, and, our investors love it. And obviously, the scale behind it, being able to, amass a large portfolio, partnering up with investors through syndication is something that's truly amazing. So I guess how many folks are out there that are actually looking to do their first deal? I'd love to see if your hands raised, or maybe a me or something. Just want to make sure that I'm providing value to some folks today. So is anyone still looking to do their first syndication? Anyone? Okay, I see a hand raised. Okay, great. So again, my goal after this presentation is to actually get you to do your first deal, right? And we're going to go through 11 steps, but to start off, obviously, you guys know a little bit about me. Background is in the NFL. I moved into private equity, now syndication. So how many of you guys actually feel this way, right? From this picture, frustrated trying to do your first multifamily deal. It's a lot of moving parts. Apartment transactions are much bigger deals. How many people are actually frustrated with this process? And, maybe it's, you can't find a deal, can't raise money for the deal, you don't really know where to start. The frustration is real. And so I've experienced the same frustration, and think like Aaron said, the first deal is usually the hardest. And after that, I think Michael Blanc says it best, right? It's the kind of like the law of the first deal. Because what happened after our first deal is we were actually moving right into our second deal after our first deal. Our broker, we were talking to brokers, we were telling them, hey, we're under contract right now buying a property in this area. He said, hey, I have another 22 units coming up. Do you guys want to take a look at it? And so, yeah, we bought that one too. Right. So the frustration is real, but if you keep, sticking to it, and if you follow this 11-step process, I'm very sure that you can close your first deal. So again, 11-step, quick 11-step, acquisition plan to actually close your first deal. And the first step is obviously defining your criteria, right? This is extremely important because you really have to narrow down your focus, right? You really have to figure out, what deals am I actually going to spend my time on? Whether it's, potential deals from the MLS or brokers or off market, you really have to figure out defining your criteria is so important, because underwriting deals, it takes a lot of time to actually underwrite these deals. And you also have to, get these brokers to take you seriously, right? If they don't take you seriously, you're not likely going to get any deal flow from these guys. It's one of those good old boys networks. They have to know you. They have to really, fill you out, because their relationship with the seller is also on the line, right? So figuring out your criteria is so important when doing these multifamily deals. So, we can talk about an example criteria, right? It can be 5 to 50 units. It can be, assets within B and C areas, markets. It can be, finance and non-recourse. It can be a purchase price of 1 to, $6.5 million, which is kind of considered a small balance loan, mid-Atlantic market. And it can be, you want to do a JV, right? And that's a simple, like, define your criteria structure that you can pretty much map out right now. Hey, I only have the capital to do 5 to 50 units in my market. I want to start off with C class because it's a lower price point compared to class A properties. I want to do non-recourse because I don't want to sign on any notes, right? So really defining your criteria is so important when you're doing these multifamily deals. So the second thing is developing your all-star team, right? And after you've defined your criteria, you now want to figure out, hey, who can actually be on my team to get deals done? What do I need? Business is a team sport, and real estate is really no exception, right? It's one of the most important parts, obviously, of being a successful real estate investor is having the right team, because really you're only as good as your team. And to do the larger deals, you have to assemble that team. So this also actually will allow you to position yourself, well when submitting offers, because you always want to get in the habit of like name dropping. That's something that I love to do, right? And I know, some folks that might be out there say, I don't want to do that, but you have to get, especially when you're starting off, especially when you're trying to develop your track record, get in the habit of name dropping and telling people, hey, I'm working with this property management company, or hey, I'm working with this investor that you might have closed a deal with. And so that allows you to really get in good with the broker, so to speak, right? And actually getting you to win a deal. So some team members that you actually want to acquire, right? The first thing, obviously, I talked about education. That's always going to be number one on my list. Education is extremely important. Whether it's a mentor, educator, consultant, somebody to actually teach you the real estate game. The second thing is equity investors, right? And, a lot of people like to say, hey, if you find a deal, the money would come. I do not believe in that. When you have a deal, you better know where that money is coming, especially in this market right now. Things are hot. I'm probably sure our next deal, we're still going to have to do, something non-refundable after due diligence, like having that money is so crucial, because when your money is tied up, when you have $100,000 hard, non-refundable in your deal and you're trying to close it, it's no joke. The third thing is property management, right? And property management is one of those things where it's, it's probably one of the most important aspect after you close on the deal, because they're going to help you execute your business plan. The fourth thing is real estate brokers, figuring out based off of your criteria that you've developed, who are these brokers in the market that actually can bring me deals, and how do I get into their short list? And when I say their short list, they first have a short list of folks, people that they have on their marketing. You might see them blasting the email. You don't see these deals on the MLS, but the short list is when they start calling you and say, hey, I have a hot deal. Like, you might want to check this out. Like, that's your goal, to get on their short list when the broker starts calling you. The fifth thing is the mortgage broker, right? Figuring out, which mortgage broker is the best person to actually help me close on this deal. And I get calls, from people all the time, brokers messaging me on LinkedIn, but I'm always doing my due diligence on a broker, because, it's just my belief that, I'm always going to be in the best interest for myself and my investors. And this broker, he wants to get paid. He or she wants to get paid, right? And I need to make sure that this broker can get me across the finish line, because we've been in deals where the broker kind of went silent. We took over communication because we're very into what we're doing, and the broker just went silent. So that's something that's very crucial that people don't usually talk about, is having the right mortgage broker. The sixth thing is the real estate attorney, and your real estate attorney obviously should be licensed in the state that you're actually doing business in, because they're going to help you draw up the contract. SEC attorney, that's something that's very important too. We work with a very, very established real estate attorney, and your SEC attorney, they can work in any state. Eighth thing is the contractors. If you're doing any value add opportunities, contractors are extremely important to actually getting the units renovated. The ninth thing is insurance broker. And we live in an environment right now where, materials are, skyrocketing, insurance premiums are going up. And so that's something that you really have to talk to your insurance broker during due diligence to figure out, making sure that your cost is in line on that particular acquisition. And one thing that you always want to ask is for the loss runs from the seller. Then the last thing is accounting, cost segregation. It's one of those things where, we do cost segregation studies, phenomenal when it comes to helping our investors with their taxes, right? Being able to offset other passive income, or if they're not high income earners, they can potentially use some of that to offset their active income. So the third step is actually going out there. So now you've, developed your criteria, got your team. Now you go out there and find the deals. And it's a hot market right now. It's very hard to find these deals. But, if you're starting off small, you can still implement some of the same strategies, from a smaller real estate investor, so to speak, space, right? From a wholesaling, going off market, finding those deals. Because as you move into the 50 unit plus space, you're going to start running into the gatekeeper, right? You're not going to be talking to the owner. You're going to be talking to maybe his assistant, and they have other, 10, 15 people calling them all the time. And so now you have to use your track record to win those deals, right? So finding deal strategies, obviously the real estate broker, we already talked about that. Direct to seller marketing, driving for dollars. I drive sometimes in neighborhoods that, that are up and coming, and maybe find a property that has a boarded up window, and figuring out, hey, who owns that property? Networking and meetups, right? That's a great way to find deals, when you're going to some of these bigger networking groups, and someone obviously, it's guaranteed that, if you go to a large multifamily meetup, someone has a deal that they're ready to pitch. So after you've found that deal, now you really have to underwrite the deal, right? And all you really need to underwrite a deal is a T12 and a rent roll. And when I say a T12, trailing 12, P&L expenses, and your rent roll. You're going to take that and you're going to give that to the mortgage broker, and that's how they're going to size the loan to let you know, hey, we can do 70% LTV, 4.25 interest rate, 3 years IO, 10-year term, step down prepayment, right? Something like that. And so obviously with the to do underwriting, you need some sort of documentation. So typically if the property is on the market, you're going to get the OM, offering memorandum, that tells you everything you need to know about the property, the rent roll that you get from the seller, who's paying what within the units. I talked about the T12. That's absolutely crucial. The market cap rate. This is something that, when people are newer getting into the real estate space, there's a huge focus on cap rate this and cap rate that. But cap rate, to us and really it's just a number, right? It's just where the market is today. But that doesn't necessarily mean that, we're afraid of, buying a 3 cap going in a 5 cap market, right? Because it's more so about, where can we take that property? If I buy a 3 cap and I say, all right, I can take it to a 7, then that's a great deal, right? Because someone might buy that at a 4. So, cap rates really don't mean anything to us. It's just an unleveraged rate of return year one on an investment property. Your submarket cap rate, and that's a little bit more granular. Let's say, for example, New York has a market cap rate, and then Brooklyn may have a submarket cap rate. And so that's something that's the more granular level that you really want to pay attention to, is the submarket cap rate. Market vacancy, figuring out, where the economic vacancy, and physical vacancy on the property. Submarket vacancy is great to know as well, obviously from a granular level, figuring out where the vacancy is in that particular area. And, these documents are pretty much standard, and information is pretty much standard for you to go out there and underwrite these deals. And the fifth thing, after you've done that, you sniff tested the deal, you say, well, I think I want to go take a deeper look at this property. Now you get a chance to actually tour it, right? So key items to really look at. The curb appeal is the first thing. And that's something that is extremely important as we, do value add deals on our assets, is figuring out, hey, what's the first thing that, this person is going to look at when they drive up to the property. Trash on the street is something that's really important too. Having your maintenance guy pick up the trash on the street, you can probably increase your rents by, maybe $25 or so just by having a great curb appeal. Interior property condition, pretty much standard whenever you're looking at properties. Finding value add opportunities after you looked at the property. Hey, maybe you say, hey, there's this vacant, space in the basement. Maybe we can turn that into a laundry room. Or there's enough, space on the lawn, maybe we can do a playground, right? If the area or if the property services a lot of families. So figuring out value add opportunities when you're walking the property. Exterior property condition, we talked a little bit about that with curb appeal, but when you walk these properties, obviously you're able to see more detailed information, whereas the broker may just try to tell you a lie on the phone. You walk on the phone and you walk up to the property and the roof looks terrible. Amenities are a great thing as well when you're touring the property, figuring out the amenity condition and just putting together your deferred maintenance list. Because when you're doing value add, obviously you're looking for meat on the bone. You're looking for deferred maintenance, so you can go and cure that and make money, when you sell the property. So after you toured the property, you underwrote the deal, you have your team, you have the capital lined up. Now you start to really submitting your LOI, right? And we never submit any LOIs unless we have an idea of how we're going to close on the property, right? For example, like right now we have an opportunity here in Baltimore, and we're looking at it. It's not in the best of the areas that we really want to, but we're figuring out, hey, can we leverage our Section 8 contacts and do a master lease on this property? And now it's going to be extremely attractive. So key LOI terms, now you're able to submit your LOI, you have your capital lined up, obviously the price, right? The second thing is EMD deposit, whether it's, I think 1 or 2% is where we we play. So, if it's a million dollar property, we might put down 1 to 2% of that as earnest money deposit. Inspection terms, things are pretty much still pricey in today's market. And so there's a lot of liquidity, people out there looking for deals. Typical inspection terms, maybe 30-day due diligence. Your money is hard after that, right? You can walk away from due diligence after 30 days, but after that, your money is hard, non-refundable. And then your financing terms as well, submitting that along with your term sheet. When you go, you talk to your mortgage broker, and they, based off of your underwriting, and you give them the T12 and the rent roll, you take that and you get the term sheet from them. And now, you're able to play ball, right? Because you have some terms on the property. Now, a lot of times these terms, especially in this market, can change because the capital markets are crazy, right? So, if you're able to do maybe a Freddie Mac small balance loan where you can actually rate lock up front, whereas Fannie Mae, you don't rate lock until actually towards the end of the after your third parties and everything is done. That's very, very important, especially in today's market where you may think you might be buying a property at a 4.5% interest rate, and it might go to 5 in 3 weeks. Commission structure, never put any commission on the LOI. I know, there may be some real estate agents out there, but never touch a broker's commission. That's absolutely not, you never want to do that. We make sure that we don't take a piece of anyone's commission. Even though I'm licensed in Maryland, I still don't do it because I'm big on relationships. Closing terms, typical closing terms are about 30 days, 30 to 45 days, depending on how hot the property is. And submitting your real estate resume, schedule of real estate owned. That's important because you want to make sure that the broker knows, hey, I'm experienced. My team is experienced. We can close this deal. It's all about winning the deal. And your list of due diligence items, right? And at the end, I'm going to give you guys a due diligence checklist. And then after that, you get the LOI. It's accepted. Now you start negotiating the contract. And some key contract terms. Using real estate attorney, extremely important, especially when your real estate attorney is well versed in syndications. A lot of times they can advise you on what other syndicators are doing, how other syndicators have approached a certain wall, because it's really all the same business, but contracts change here and there depending on the actual property. But real estate attorney, best money spent. We use the same one. Get a real estate attorney. And then it's when you're negotiating your contract, obviously you're just transposing the same information from the LOI into the contract. And one of the things that's very important, especially in due diligence, is a lot of times sellers try to run your clock, start your clock before you even get any due diligence. Due diligence is the most important part when putting a property on a contract. And so we actually had this, issue, within our last contract, actually, really from another syndicator, which was a little weird, that he didn't understand this, right? Getting due diligence documents from the seller before, your clock starts, or that 30-day due diligence period starts. That is extremely important because brokers, they just want to close the deal. The seller wants to close the deal as quickly as possible, but your interest is yourself and your investors. So never skimp on due diligence. And your inspection access terms, whether it's, hey, we can inspect the property within 14 days, after contract is executed, we'll give you notice. Your lender requirements, extremely important. Your lender might, is going to want some sort of property condition assessment, environmental, all of the things that they will let you know up front what they need. And, your security deposit terms, your EMD, same thing, really important. But always at the end, really consult professional legal advice when you're doing any sort of contract negotiations on these larger deals, because these deals have more risk to it when you're doing larger deals. And my investor capital is extremely important to me. we're on this ride together, and I want to make sure that I protect them. Then you start your financing period, right? So you got the property in the contract. You negotiated the contract. You've done some due diligence. You start that financing period, right? Figuring out the debt structure on the property as you go along. That's typically the things don't typically change until you actually get that loan commitment going to loan committee, because one of the things that I've learned in my past, whether it's our own deals or for the firms that I've worked for, is asking these bankers, hey, like who am I actually, like, when is this deal actually going to committee? Because that's completely different from the terms that they might tell you today. When that property, when the loan actually goes to committee, things can change completely, and they may start changing things on you. I've actually I haven't had that done to myself, but I've heard other syndicators dealing with that. But if you're able to rate lock up front, that's great, because your rate and everything is going to be locked up front. Knowing the lender list of cost, these third-party inspections are very expensive. Inspections, $250 a unit. Environmental, $5,000 to $10,000 depending on how big the property is. All these reports that they may have, whether it's like asbestos or any sort of structural engineer, that things cost. So a lot of these lender required inspections, they cost, and they can probably average about maybe $30,000 or so, depending on the size of the property. Property occupancy requirements, another huge one, because some lenders, like let's say Freddie Mac, they have a 90 for 90 rule. So it's like within the last 90 days, has your property been 90% occupied? And if it hasn't, then you may have some problems with actually getting this property financed, because they have strict terms. But usually if you're doing a smaller deal, let's say 20 units, you have 2 or 3 units that may be vacant. That's a huge swing between being maybe 92 and then 84, right? Because it's a lower unit count on a percentage basis. So knowing the property occupancy requirements, extremely important. Asking the seller, hey, do you have evidence that this property has been occupied for the past 90 days? 90% occupancy, really huge. DSCR requirements, knowing how the lender is actually underwriting the property, because they're going to size the loan based off of debt service coverage ratio. That's typical in the lending industry. Key principal net worth, finding those who can actually sign on the loan. If you're doing any non-recourse, it's not personally guaranteed unless there's something called bad boy carve outs, which basically means that we're not holding you responsible for this loan unless you commit something like fraud. Key principal liquidity, typically in the agency space, Fannie, Freddie Mac, they require 10%, post-close liquidity, net worth of 100% of the loan amount. That's typical within, the multifamily space doing larger transactions. So having that liquidity is something that you're going to have to show the lender. Renovation budget is important too when you're giving that to your lender if they're financing the renovation. Knowing their required reserves. We actually had an issue with one of our last properties because we were acquiring it a little bit creatively. And so, our lender required, like about 6 months of reserves just for the closing costs, just in case we weren't able to actually close on the property. Or just in case actually, the city had an issue with the documents and rejected the title. Insurance requirements, really important as well, figuring out, hey, this lender wants, X amount, this lender wants, their entire loan secured by this insurance, making sure that they're protected. And obviously your final loan commitment, right? That's something that you don't typically get until maybe 1 or 2 weeks out before you actually close on the property. But the point of this is get a head start on your financing as early as possible and interview your lenders, because it sucks when you have, you know, all this money tied up, non-refundable, your investors expect you to close, and your lender is just dropping the ball. Not being able to turn in one document can probably, kick you down the road from a closing perspective, an extra week or two. So number 10, after we've obviously, we're going through the financing process. Now we can start to prepare these investor docs for our investors. And there are many ways that you can close on, properties. We primarily focus on the syndication space, but, you can do joint venture. Obviously, for folks who are experienced in the real estate space, getting that operating agreement together, your corporate docs, joint venture space, and your ACH deposit form, how you actually going to pay your investors, and the wiring structures to get those funds to closing. And on the syndication side, same thing, right? Similar structure, your operating agreement, your corporate docs, your PPM. If you're doing, in the syndication space, you're selling securities. And so having that disclosure up front, having that PPM done up front, that takes a lot of time. A PPM is basically all the disclosures on the investment, good or bad, talks about everything, soup to nuts. And your subscription agreement. And this subscription agreement is actually what the investor has as their receipt that, hey, we've bought in, or we've subscribed to this deal. We've bought these securities. And your ACH deposit form, you want to pay your investors their returns and get that information up front, and the wire instructions. So always consult, professional legal advice. I'm going to say it again. I am not cheap when it comes to legal advice. Good advice pays me, and it saves me in the long run, right? So, get the great legal advice. If your SEC attorney is well versed in syndications in the multifamily space, I'm big on teams. Leverage them to actually do your first deal. And then, you prepared. It's time to close the deal, right? You've got the investor commitments. Congratulations. The money is there. It's one of those feelings where it's like, I can chill for about 2 days. I'm just waiting for closing, right? And then you actually close the deal, and now all the work starts, the stuff that they don't talk about. So you start taking over. You have that operating account so there are multiple accounts that you want to create. The first thing is the operating account, where you have your cash coming into that you can sweep from the property management account, down to your account. We use a bank called Axos Bank, because it's one of those banks where they don't charge you for money coming in, but they charge you for wiring out. So we just use that as an operating account. Your security deposit account, something that you definitely want to have bearing interest. I know, like in Baltimore City, we have to pay interest on security deposits. Your capital expenditure account, that rehab money that you have to track to go out there and do the value add deal, the renovations, have an account for that. Your tenant notices prior to closing is extremely important. I'm big on the nitty gritty and details behind things, and just having those notices, because some tenants, they would say, hey, I didn't get the notice. That's why I didn't pay rent this month. But we do 3 notices. We do a notice about a week before, a notice the day of closing, and a notice like 3 days after closing. And so there's no reason why you shouldn't pay rent that month. Local municipality notices, you may have to give someone notice that you now own the property. Maybe you have to update a rental license. Very important there. Your financial reporting to your lender. They're going to require that you submit financial statements at least once a year, tax returns on the property. Your investor communication, super important there, because I'm happy to say that none of my investors actually call me or ask me anything about the property. And the reason is because I'm so transparent. My emails are like books. I want no doubt in my investor's mind that I have control of the property and I have their money in my best interest. And so I've never had an investor call me, hey, what's going on with the property? They know exactly what's going on, and we do quarterly updates. Business plan implementation. One of the things that people really don't talk about, they talk about, hey, acquire the deal, raise the money. but this is really where the money is made. This is where you're able to maybe get money on the promote by being able to outpace your expectations for your investors. Business plan and implementation is how you're actually going to do more and more deals, having your proof of concept. So that was a very quick 11-step process to actually do your first deal. Was that helpful? I'd love to see any hands raised, or if anyone has any questions about anything, I'd love to answer it. See, we have a hand raised here. Aaron, I'm going to give the mic back to you. Maybe you want to handle the moderation on that. But I'd love to answer any questions that someone may have about that entire process.
Go in for Stephanie.
Persephone? She have a question?
Peggy has a question when you get to me.
She said, was there eight slides? So she want to know, like, was there for the 8, what was the 8th step? The 8th of the steps.
The 8th step? Did I miss a slide? I said I missed a slide. Oh, wow. Oh, I apologize about that. I missed the slide. So that slide was supposed to be your due diligence. And I'm going to talk about due diligence really quick. So due diligence is something that's extremely important after you negotiate the contract. Thank you for pointing that out. I don't know how that slipped out of there. But in due diligence, when you're doing due diligence after you negotiate that contract, usually it's about 30 days. Like this is the phase where money is made or lost, because and I'm actually gonna give you guys a due diligence checklist, and it's exactly the same checklist that I've developed from the institutional firms that I've worked for. Everything that you can actually look for in a multifamily deal, and it pretty much covers everything, right? Because you want to go in with your eyes wide open. After that seller gives you like the due diligence documents, after the contract is executed, and you want to make sure, again, your due diligence doesn't start until all of the documents within my due diligence request list in this contract has been given. And we're very hard on that. And if there's something that we placed on there that we're like, we don't necessarily need that within this transaction, then we might tell the broker, hey, we're good, let's start the clock on that. But a lot of sellers, they want to rush you. They just want to give you, maybe one quarter of information, P&L, and actually, they say, hey, go inspect the property, right? We want to make sure that we do full due diligence. So the first week is usually lease auditing, right? All of the documents that they give you, the P&L, the leases, the rental licenses, everything from the administrative side of things, within the first week is where you really want to spend most of your time, is in the due diligence phase of the lease audits, the P&Ls, making sure things match up to what the broker actually said or what you underwrote. And then after that, on the second week, that's when you start doing your inspections, and you want to get ahead of that, inspect all units, take photos. We use an app called Trello that allows you to put notes in, specific tasks, uploading pictures, whether there are issues that we might find, allows us to really collaborate on due diligence. And so, after that, that's when your third party is going to take about, maybe, 2 weeks or so to actually get those third party reports back. Getting those reports ordered, doing due diligence early is very important, because appraisers, they can take a long time. Structural engineers, some of those reports take a long time to actually get back. So you want to give yourself enough time to review a lot of that material before you get to that 30-day mark, because in this environment, when you're putting properties on a contract, like, before your money goes hard, I want to make sure that I have all the information before I make that decision, because when that money is hard, it's hard, and we have to close this deal. So that was number 8. Thank you for calling that out. I don't know what happened with that slide, but The eighth step is actually doing due diligence on the property. And, you know, I am a big proponent of this phase here.
Excellent, excellent. Peggy, please ask your question.
Peggy, I think you're on mute.
Come on, there we go. Thank you for a great presentation. I'm sure a lot of people are totally confused and see that it's a lot of work. And as the nest egg builders, that's why we offer positions as passive investors. So like, oh my God, all that work. Yeah, I've been there, done
Yeah.
that. So I was just curious because you said education was so important and before you did your first deal, how long did you take to get educated before you actually said, I'm going out and find my first deal, would you say?
So for me, education is a continuous state because you know, I knew that I wanted to do multifamily from the day I set foot in the commercial real estate space. And for me, it was a combination of getting the experience from the private equity shop that I worked for, but then also attending, meetups and attending networking events, but also building that team as well is extremely crucial, because I've seen a lot of operators that started off by themselves. I've met them at a lot of different networking events, and the moment that they grasped onto a team, it can be a 2-person team, that your trajectory just accelerates so much quicker, because now you have 2 people that you can take those tasks and break them out to actually go out there and do deals. So my partner is kind of like the back office. He's in the tech space. He loves, crunching the numbers. He handles the day-to-day operations. I handle the construction side of things and actually getting our units turned. And so if I was doing a lot of that stuff by myself, I wouldn't be able to do it. And so, to answer your question, I would say for me, I got into real estate in 2017. We did our first deal last year, right?
Okay.
That was some time. I've seen people do deals within 6 months, 12 months, 3 months. It comes down to your level of comfort. And I think for me, it was a mixture of getting the education, getting the knowledge, but then also building the team as well, because you have to you have to focus on that team.
Well, I agree 100%. You've got to have a good team and it takes time to find one. And that's why you need a good coach and a good mentor working with you, help guide you.
Absolutely.
I had a nut. Well, I wondered if you did cost segregation after you closed.
Yeah.
Yeah, you did?
Yep.
Okay.
Yep. Yeah. Cost segregation. Absolutely. It's a tremendous impact on the taxes for our investors, being able to, give them the depreciation to offset their other passive income. And then also, if you make, I think the rule is if you make, less than 100,000, then you can use that in your personal active income as well. And I think above that threshold, it starts to diminish. I think every, $1 for $2 or something like that. But being able to have, especially when you're full-time syndication and you're a full-time real estate professional, man, that those losses, real estate is the ultimate cheat code to wealth. Being able to use those losses against other income, being qualified as a real estate professional, the ultimate cheat code.
That's great. And then I have one last question. Well, it's not really a question. So you're closing at a 3.5 cap. You've got a 4% interest rate, and you think that in a couple of years you'll be able to turn that around and sell it at a 7 cap. And having been in the business since the 80s, your cap rates should be 2 points above whatever the lender rate is. And when the rates are up at 7% by the end of the year and might continue to go up, and we are going to go into a down market over the next, well, we're at the top of the cycle. So now now it's going to go to the buyer side. So you'll be able to buy a lot more properties. But how do you think you could get a 7% cap when you sell, when you're at a 7, when they would have to go get a loan at 7%? Because they're not going to be able to take over your loan more than likely because you're doing interest only.
Yeah, I think one of those things obviously that's extremely important in today's market is figuring out how to model your underwriting to protect yourself from a downturn in the economy, right? And whether it's doing the standard 10 basis points cap rate expansion every year for every year that you hold the property, being able to maybe forecast where rates may be at the end of your business plan. I think for me, how we look at properties, we still implement some of those traditional defense mechanisms to make sure that our deal is underwritten somewhat conservatively, right? I think for us, our biggest thing is, where is our debt going to be in the long term, right? Because if the cap rate is, let's say we built that 3 to a 7, and then today it's 5, but then a couple years down the road, or maybe at the end of the year it's a 7, or maybe 2 years down the road it's a 7, right? We don't necessarily want to sell that property, right? Because it's
Right.
not it's likely not what we modeled. It's not where we want to sell at. We want to sell at a lower cap rate. Debt may have changed. And so the biggest thing that we look for in cases like that is obviously debt is the biggest killer of real estate deals, right? Maybe you have to sell it because, maybe you're on a bridge loan and, you have to get out of it. Or your debt wasn't properly strategically placed enough so you can withstand a recession, so you don't have to sell the property. And so the first thing is figuring out, hey, what is my debt going to look like in the long term? And if I don't have to sell the property, or if I don't want to sell the property, I don't have to, because it's structured in a way that allows me to ride through that recession, right? Ride through on the other side. So when the economy turns around and rates can go back to maybe 3.5, then my property is a little bit more valuable then. So
Not in your lifetime. So why are you not going at this point when rates are going to go up? They are not going to come down. Why aren't you going into a regular 25-year fully blown, at 3.5? Why is it interest only? Because they're not going to let you do interest only for 25 years.
Yeah. So the types of loans that we focus on is Freddie Mac loans. Freddie Mac small balance loans right now is our sweet spot. And they don't have like a 25-year term on just the agency side, at least to my knowledge. I'm not sure. The particular structure that the product that we look at is 7, 10, 10-year term non-recourse loans. I'm not familiar with any 25-year non-recourse, or maybe that might be HUD or something like that. I'm not familiar with that space. But really, that particular, from what I've seen within that, 25-year term is more so recourse. Maybe have you seen a 25-year term on non-recourse deals?
I don't work in that area anymore. But when we were in our commercial loans, we were able to get it, but it was always from a bank. We never dealt with Freddie Mac or HUD because they have too many other costs that you have to do, or too many other requirements, and ends up costing a lot of money. Okay.
Yeah. I've seen deals, bank financing, traditional bank financing, do 25-year amortization. But we more so focus on, the non-recourse aspect. Those deals we don't really want to sign long-term on any notes. But that can be a good option if that's something that, an investor chooses to do. And, they have great, rates with that as well. But we found the best terms to be with with, with agency from a non-recourse perspective.
Well, just keep running those CCIM numbers. They I come from the exchange world, so we are counselors, and the exchange group back in the 50s, 60s, I guess it was. I wasn't in with them then, but they said they had a falling out between the CCIMs and the counselors, because the counselors looked at their people they worked with as lifetime. They worked with them for a lifetime and build their asset for them. And so they made up this CCIM, means can't close, I miscalculated.
That
I
is
think
funny.
yeah, it is funny. I just wanted to share that with you. But hey, look, you had a great presentation. I think it was wonderful. I hope the people really got a lot out of it.
Thank you.
Thanks.
Nicole, I see some of your questions. Do you want to ask, or you want me to just answer it? I mean, ask your question.
I don't remember my first one, but my second one was just how long did you work in PE, the equity firm, before you branched off to do your own thing? And do you think you would be as successful or doing what you're doing now if you didn't get that on the job experience first?
So for me, I started off my first stint in real estate was in the brokerage space, doing commercial brokerage, multifamily, office and retail, tenant rep, and then for 3 years after that was when I was working for different firms. And it's a great way to learn, but it's surely not the only way. I think for me, it was, hey, I want to learn a lot about real estate, a lot about different asset classes very quickly, being able to work for someone and then take that and go do my own thing. But if you're trying to go off and do your own thing, it's certainly not one of those, because there are so many syndicators out here that are super successful at what they're doing without having any lick of real estate, professionally in their background besides doing their own thing, right? I think as long as you're able to find someone who can show you the ropes, who can educate you, finding a teammate who can pull you into a deal, whether you add value on the deal from a capital raising perspective or you find a deal, there's certainly no one way to do to get into real estate. But I've found that, the PE route worked well for me based off of my goals and what I wanted. But certainly for you, it might be something totally different, and you might luck up and not necessarily luck up, but you might find someone tomorrow that can coach you, show you the ropes. You guys find a deal, and 2 months down the road, you're a syndicator. Did that answer your question?
Yes, definitely. But you know what? I'm trying to get out. I'm trying to build my cash flow passively so that I can leave my W-2. And I'm always wondering, should I try to get, sorry, I'm training background, should I try to get experience professionally instead of just, jumping both feet into doing it myself, not myself, but with the team. Because I really don't want to be tied to a desk or go through the whole W-2 thing again, but it would be valuable experience to take and transition.
I think she's on a train right now, so it's kind of hard to hear her, the background noise.
Yeah, I think I understood what you were saying from a perspective of maybe going out and learning for someone else or taking a job somewhere, I think is what you were saying. But your goal is to build cash flow. I would honestly say if you can find jump in one of these meetups and find someone that's actually doing deals in your area, and find a way how to, because there are really three things that you need to get these deals done, right? It's either money, the capital, it's either the deal, the capital, or the experience. And if you can find a way to add value within those three, you can do deals all day long. The biggest thing out of that is capital, because in this space, you only rise to the level of your capital. So if you're able to get that capital raising it from friends and family. Maybe it's, you can find an operator that says, hey, if you bring in $200,000, you can get into our deals. We can do some deals together. And that's a great way to get a head start in the real estate space, leveraging someone else's experience, someone else's deal flow, and just bringing that capital to your partners. Great way to actually get in and actually do your first deal.
Love it. Anybody else want to ask us before we go to the after party? Fred or Lawrence? Persephone? Okay. She said, besides real estate, what are your hobbies?
My hobbies, I'm ashamed to say I don't have any hobbies. I think I'm a real estate junkie. I think I've just admitted I'm a real estate addict. Yeah, I honestly do not have any hobbies. My hobby is, I think, it probably sounds bad, right? I want to learn how to do golf because I'm trying to find something professional, and I'm just a washed up professional athlete right now. But I would say right now my hobby is creating wealth for my family, right? And I enjoy real estate. I enjoy doing what I'm doing. I'm passionate about it because I know the benefits. We get cash flow every month from, our portfolio, and I know the growth that you can get, whenever you're in real estate and you're doing cash flow acquisitions, building that, that wealth, that retirement income early on in your phase. And I know it might sound cliche, but this is something that I really enjoy doing, and helping other people, put their money to work in some creative investments. So, ashamed to say I don't have any hobbies, but I'm hoping that I can come back to this meetup and say I'm a golf champion somewhere. So.
Awesome. And last question before we go to the after party. She asked, you mentioned Section 8. Is that your niche?
Section 8 is not my, let me say this. So we own properties like single family still, because I still think, contrary to what people say, they may say, hey, don't buy a single family, buy multifamily. I'm cash flow. It doesn't matter what it is. My thing is cash flow. I buy for cash flow. So my single families in my state, Baltimore, cash flow for me at least $600 a month. And I was actually able to get financially free faster in the single family space, the properties that I've owned 100% through the BRRRR strategy. I've actually been able to get financially free quicker in that space than the multifamily space, because you own those properties yourself. All the cash flow is going to you. And in these, multifamily deals, a lot of times you start making money when you get to control the economics more. So you make money on the acquisition fee, the cash flow, depending on how big the property is. You probably only get that $10,000 per month cash flow that you have to, split up. Say $10,000. Sorry, not per month. On an annual basis, maybe on a $1 million rent roll, right? You get, typically the number is 1% of gross revenue collected, right? So $1 million rent roll, gross revenue collected, 1%. And then you have to break that up, and that still is distributed, right? But until you start playing in those spaces, then maybe you can start, really building the real money in real estate during the whole period, and then you get paid on the promote whenever you sell the property. So that's why a lot of people try to get out of these deals quickly as possible to realize their promote, if they're not making money in between the deal. But I say that to say, for me, it's all about like cash flow, right? It's all about, how can I bring in that cash flow every single month to supplement my lifestyle? And again, I've been able to get to the financial freedom quicker in the single family space. Properties that I own 100% quicker than the multifamily space. And so I'm sorry, I forgot exactly what your question was. I just got excited about telling that story. But I think I may have answered your question. Right? Did I answer your question, Aaron?
I think you did. I think you did. I see put LOL. I think you did. And
Okay.
one more question from Nicole before I go to the after party. It's all your single families in Baltimore.
Yes. Yep. It's a cash flow city.
Yeah, definitely gotta talk about that. Definitely gotta talk about that. So man, I just want to say thank you so much, man. Great presentation. Just thank you so much for all the information. Educate people. This will go on the YouTube page tonight. So I just want to say to everybody out here, my little message to everybody is make sure you tell everyone that surround you how much you care about them. Life, you're never promised tomorrow. Make sure you tell people how much you care about them because you never know. It's not just the current events, but I think a lot of times we take things for granted and really can't. I think just the turn of events, what happened with COVID, everything like that should teach us that it's never promised. So I just want to tell you guys, tell somebody, you care about how much you care about them. Tell them, because you never might not have the opportunity ever again. All right, sir. Well, thank you so much for being on here. We're gonna go to the after party. We're gonna get off the recording, but to everybody else, we'll be here next week, next Thursday, as always, at 7 p.m. God bless you and take care.
Yeah, I appreciate it. And sorry, one thing I want to drop here was just the due diligence checklist that I talked about. I know I accidentally missed that slide, but if you go to my website, merlynacquisitions.com, it's on the screen right now. We have a free download due diligence checklist. It's absolutely, again, what I've compiled from being, working for institutional firms, deals that we've acquired, soup to nuts, everything you need to know, you need to look for in the due diligence phase of your acquisition. So thank you so much, Aaron. I appreciate you giving me the platform to speak today, and go do your first deal.
And I promise you, sir, this will not be the last meetup or podcast you be on. I'm telling you,
Absolutely.
You got some people on here that's going to put you on airs, and once they see you on the replay, definitely, man. So appreciate that. Thank you so much.
Appreciate it, man.